Welcome to this week's episode of the Move Smartly Show. Today, I had the pleasure of speaking with Doug Hoyes, a leading expert on consumer debt and personal insolvencies. Doug is the co-founder of Hoyes Michaelos, and he hosts a popular podcast, Debt Free in 30, and is a frequent commentator in the Canadian media. So Doug, of course, works directly with households that are facing financial stress. So he's a very unique look into what is going on the ground today with Canadian households. And we're going to unpack some of the things that he's seeing, some of the differences between renters and homeowners, why in some cases with homeowners, their debt levels are so high they cannot even file a consumer proposal. They're forced into bankruptcy. And surprisingly, why he thinks insolvencies are actually lower than what he thought they would be, and why he is expecting things to get worse in 2026. I hope you enjoy today's discussion with Doug Hoyes. All right, Doug, thanks so much for taking some time to join us on our episode of Move Smartly this week. Looking forward to hearing a lot about the things that you're seeing in your business and on the ground.
Great to be here, John.
Awesome. So why don't we just kick things off with, some of the trends that you're seeing right now in your business, and how things are different from, pre-pandemic levels in terms of the types of clients you're seeing and the volume of activity and clients that you're seeing.
Well, if you want to go back to 1987 and we were to draw a chart, the consumer insolvencies kind of were going up and up and up and up, and they peaked in 2008, 2009. You remember the last big crisis. And then they were falling for about 10 years, kind of bottomed out, bounced around the bottom, and then we're starting to rise again. 2019 was a very busy year, and then 2020, poof, everything shut down. And the number of consumer insolvencies, and I'm speaking mostly about Ontario, but the trends would be similar in most of the rest of Canada. So then we had a few years where they were dropping, and they actually hit like 50% below where they were. Bottomed out in 2022, and since then they've been gradually increasing. So 2025, higher numbers than 2024. What's most amazing to me is they aren't as high as I would expect them to be.
Interesting.
And I wish I could tell you why that was, because you have me on as the smart guy, and I don't know the answer. So, I mean, you know what's going on in the world. Debts are at record level highs, right? Like you look at the credit card balances, never been higher. You know what's going on in the whole real estate world better than I do. Unemployment is inching higher. I don't think the average guy in the street would say, hey, everything's wonderful. And yet the rate of insolvency growth here in Ontario, and I'm talking specifically about personal insolvencies, consumer proposals and bankruptcies, is up only a little bit this year. And I believe when the October statistics are released, which will be sometime in the next week or two or three, it will show not a very big increase in October compared to last October, might even be flat, which is astounding to me. And, my only theory is, well, I guess we just keep kicking the can down the road.
Interesting.
I really I can't explain it. My other theory is there are at least two different economies and maybe hundreds of them, I don't know. But the people who bought a house 40 years ago, they're rich. Even if they bought a house 10 years ago, maybe even 5 years ago. But the person who bought a house or a condo in February of 2022, which I think was the last sort of peak, they're not doing so well. And the person who has never owned a property has obviously built up no equity whatsoever, and they're the ones who are hurting the most. So your question to me was, what am I seeing and what are the characteristics of the people I'm seeing? Well, I guess the first characteristic would be someone who comes in to see me to file an insolvency is most likely to be a renter, not a homeowner.
What percentage would you say roughly are renters versus like
I can
just
tell you the exact numbers.
okay.
The In 2011, It's great that you've got an old man like me on because I can tell you, well, in the 1950s, here's what happened. In 2011, a third of my clients owned a home when they filed an insolvency.
Oh, wow. That seems
In
high.
Yeah, in August of 2022, it was zero. It's
Mm,
the only month in our almost 30-year history where we've seen a zero print.
hmm.
Last month, October, it hit 10%.
Okay.
I don't know if we've released any of these numbers publicly yet, but and in November it's trending a little bit down. You know, it bounces around, so it'll probably be like 7 or 8% by the time we get the results for November. So that is a lot higher than it was 2 or 3 years ago, but a lot lower than it was back in the more normal times. And that number makes sense to me because if you bought a house and it's gone up in value by $500,000 and you've managed to incur $50,000 worth of credit card debt, it's no problem. You refinance, you get a HELOC, you get a second mortgage, you sell the house, whatever. Back in, 2011, your average house was worth, I don't know, half what it is today. Like it wasn't unusual for someone to own a $300,000 property. Okay, well, even if it went up a little bit in value, there was no way it had gone up. There wasn't a whole lot of equity in it. So you could file a proposal or a bankruptcy and not really have to worry about losing your house because there wasn't any equity built up in it. But last year or the year before, there was tons of equity, which is why homeowners were not filing insolvency. That trend is changing, but it takes a long time to move the ship. And so I would predict that if we end up at the sort of in the 7 to 10% range this year, then maybe next year it's 12 to 15%. Maybe the year after it hits 20%. So I would predict that we will see an increasing number of homeowner insolvencies because there just isn't enough equity to support their other debts.
That's interesting. Now, I mean, you said a couple of things that stand out. I mean, looking back at 2011, where I think you said it was roughly a third were homeowners, in addition to prices being lower, I mean, was it also just the fact that back then home prices were not appreciating by double digits? Like that rapid acceleration largely happened after 2014, 2015. So to your point, is it just the fact that prices were going up by 20,000 a year, 30? So people were accumulating more debt than they could manage and roll over into their home. Like, you think that was part of it that, and after that, we built this system where people could start rolling their credit card debt and consumer debt into their homes because prices accelerated more rapidly?
Yeah, I think that's exactly it. I mean, in 2011, and we're just picking on that year, we could
Sure.
talk about other years, but I mean, go back 50 years. A house was something you lived in.
Mhm.
It wasn't a financial asset, it wasn't an investment. It was something you lived in. Whereas now, no, it's a place to park money, it's an ATM, it's an investment. And so you're right. If I bought a house and 5 years later it had gone up in value by 10 or 20,000 bucks, no big deal. I could file a consumer proposal. I could go to my creditors and I could say, hey, look, I've got this asset that is now worth $20,000 when I subtract the mortgage out and everything. I got $50,000 worth of debt. How about I make a proposal where I pay you back half? But when you get to 2022, I got $50,000 worth of credit card debt and I got $500,000 in equity because it's going up $100,000 a year for the last 5 years. There's no proposal to be made. So yes, it's that rapid increase that prevented homeowners from getting into trouble. But of course, if there is a decrease, in fact, there doesn't even have to be a decrease. If real estate prices stay flat
Mhm.
and my debt levels are increasing, I got a problem.
Mhm. Mhm. Now, one other thing you kind of touched on uh, was the fact that things are not as busy as you expected. Like you would have been expecting to see more people financially strained. Now, this, of course, is in some ways a little bit at odds with what people are seeing in the headlines when they see headlines about power of sales surging. So, to unpack that further, is it possible that, many of these people who are forced to sell their home under a power of sale may not necessarily be bankrupt or insolvent? Maybe Like, is that possibly one of the reasons for this disconnect?
Yes. So, and let's be very precise in our terms here.
Hmm.
Insolvent means I got more debt than assets,
Hmm.
or it means I can't pay my bills every month. I got a cash flow shortage. And I don't know, maybe half of all Canadians are insolvent. I don't know. I've never done the math. Um, Bankrupt is a legal state. You come in to see me, we file the paperwork, you are officially bankrupt, we notify your creditors, we distribute your assets. Um, so I'll give you, anecdotal evidence because that's always the most scientific way to do things. I talked to a lady yesterday who had first called me in the summer, and she said, "Yeah, I've got this rental property." And you and I can talk about rental properties next. I got this rental property. It was a condo. I've been renting it out for a couple of years, but it's obviously it's never carried itself. That's not a thing. But it was okay when I was throwing in $1,000 a month because, oh well, it was going up by $2,000 a month or something. So it seemed like a good deal. But now it's going down in value. I can't continue to pay for it. So in August, I stopped making the mortgage payments because I can't, like I can't afford
Oh,
it.
because they
So
can't. Oh, I thought they just decided a principle.
no,
Okay, it's
no.
not. It's not laughing matter then.
Oh
That's
no,
fair.
they
Just
just couldn't. So this is and
wow.
I can't remember the exact numbers, but let's say she's got a job and she makes, I don't know, $5,000 a month net or something like that.
Okay.
She's got her own place that she lives in, pays her own rent, buys her own groceries, whatever. So she's fine on her own. But then she's got this rental property that she has to throw $1,000 or $2 a month at. And I mean, every rental property I've ever seen, where I'm talking about somebody who rents out a condo, there is always a shortfall every month, unless you paid for it in cash or something. But if you've got a, conventional mortgage or even a high ratio mortgage, you're probably throwing 1,000 or two or three at it every month, assuming there's no major repairs or anything. So in her case, she said, "Look, I just can no longer do it because I got all these other debts as well. Now they're coming after me. I just can't do it." So she stopped making the mortgage payments in August. So I talked to her. So we're now, whatever that is, 5 months later. And I said, "So what's the bank doing?" And she said, "Well, so far, nothing." I said, "Well, that's strange because if you owed me, I don't know, $600,000 or whatever it is, I'd probably be doing something." And she said, "Well, they sent me a letter that I got to make my mortgage payments, and that's pretty much it." And I said, "Well, that's weird. Now you've got some other debts. Yeah, I got a line of credit, I got a credit card, whatever. What are they doing?" "Oh, they're calling and yelling and screaming, and they're threatening to take me to court and everything." I said, "Okay, that is weird because if I was the bank, I would be, doing my power sale, my foreclosure, whatever, get the property, sell it, recover some of my money." But again, this is anecdotal evidence. I'm talking about one person that I talked to yesterday, but the bank didn't seem too concerned about it. And perhaps the reason is she's not the only customer of the bank who stopped paying their mortgage on their rental condo. And they've got many thousands of other ones. And if they were to go and power of sale all of them, then the market would completely collapse.
Interesting.
So it could be that they're kind of slow walking it.
Hmm.
Okay, we're moving into the winter. We don't really want to be paying heat and everything. And if it's a townhouse, we don't want to be shoveling the driveway or whatever else we got to do. So let's wait until the spring and maybe everything will be better and then we can foreclose on everybody then. So I think, and I have no proof of this, okay? I'm just making stuff up here. I don't have any stats or anything. I'm not a real estate guy. But what I am seeing is a lot of clients calling me saying, "I'm no longer making the payments, but nothing has happened yet," which tells me that we are in the early innings of whatever this situation is.
That's super interesting, and you're right. I mean, if we look at the statistics, a lot of the big banks have been publishing stats. They don't publish, I don't think, stats on actual power sales, but they publish on their number of borrowers who are 90 days in arrears, and that has been like a hockey stick curve
Mhm.
increase. You're right. I think the bottom was in like 2022. No one was 90 days behind, and it has since surged. So. I mean, it's an interesting point where what you're saying, which is basically that maybe they don't want to push it they don't want to flood even more inventory on the market. I mean, that would be super interesting. I'm guessing though, the person that is in that situation, I mean, must have some equity, right? Like the bank's got to feel. And
Mm,
are you finding, no, you're not finding that with many people?
no, I mean,
Hmm.
Because I asked them, I say, well, okay, wait a minute. Why don't you sell the property then? Like,
Yeah.
hello? And the answer is, I can't. I
Oh.
would not get out.
Oh.
And the other piece of this, of course, is I'm talking about you got the mortgage with one of the big banks. But of course, a lot of these people also have a second mortgage with a private lender or, some other entity. Those other entities tend to be much more aggressive because they gave you a 1 year mortgage. And every time I see a private mortgage, which is a second mortgage, it's always a 1 year. Maybe I'm not seeing the other stuff, but that's your typical term. High interest rate. It could be 12%, 15%, 16%. At the end of the year, it's like, yeah, we want our money back. We're an actual investor. We want that money. But it's like, well, okay, dude, why don't you take over the first mortgage then and sell it? No, because then I'm throwing good money after bad. So nobody has any incentive to do anything now and crystallize their loss. They might as well just wait
Wow.
and see what happens in the spring. So now that stat you quoted about the number of mortgages that are 90 days in arrears or over,
Hmm.
the absolute number of that stat is not a big number. I don't know what it is, 1%, 2%,
I
like
think it's like
3%.
it's like 0.5-ish,
Yeah,
just under
like
that. It's small. Yeah.
yeah, almost zero. But compared to 2 years ago when it was zero, that's a
Hmm.
massive increase.
Hmm.
And so I think the banks are going, okay, well, if it's less than 1%, we don't have to freak out too much. But I think with each passing month, it gets a bit worse, a bit worse.
Hmm.
So I don't know how long they're all going to wait. But at
Yeah.
the moment, that's what we're seeing. They're waiting.
Now, I guess one thing that kind of jumps out from what you're saying is, a lot of these investors were cash flow negative forever since they bought these, whether it's $1,000 or $1,500 a month. And yet many of them were fine and were able to manage it up until the peak. Now, what's happened? Like, what has been sort of the tipping point since then? Is it higher interest rates? Is it other costs? Is it higher payments on multiple investment properties? What do you think the tipping point has been on some of these people? Because the person you spoke with was managing it well up until recently.
All of the above. So this particular person also has another, I don't know, 100,000 bucks worth of unsecured debt. So how did they buy that rental property in the first place? Well, I had a bit of cash, but then I also took some money from my HELOC or maybe from an unsecured line of credit, maybe from here, maybe from there, borrowed some of my parents, whatever, because I know real estate always goes up. I can't lose, so it's fine to lever up. Well, I got to be making the payments on all those things too. So if I have a $50,000 unsecured line of credit at the bank because I've got a good job and everything, I go out, I buy my rental property, and like you say, every month I'm short 1,000 or two, no problem. I just take it off my line of credit, whatever, because I know that someday I'll sell it and I'll make three or 400,000 bucks, so it's not a big deal. Well, guess what? After 25 months of putting $2,000 on your line of credit, you're now maxed out. Can't do it anymore. And everybody hits that breaking point at a different point. It could also be that my main job, where I work as an employee, I'm now making less money. I'm not getting the overtime I used to. Maybe I've been laid off. Maybe I've had to pick up a different job. Maybe I've gone through a separation or a divorce. You put all those factors together, and those are the people who are under the most pressure. Maybe my tenant stopped paying. Maybe there's a big flood at the condo or something. It's all manner of things, but in most cases, the problem is math. It just catches up to you. Unless you're the federal government, you cannot run a deficit every month forever and not experience the consequences.
So, I mean, kind of what you're saying is it's not really just this didn't just happen. It sounds like for most of these people, it's been kind of a buildup over years, and now they just can't keep doing it. The
Yeah,
money's run out.
yeah, it's like, my chocolate chip cookie addiction, which I'm not proud of. But if I eat a bag of chocolate chip cookies today, I feel great. And if I do it tomorrow, I feel great. And if I do it every day for 4 years, I'm probably dead. right? Because it builds up a little bit. It feels pretty good at the start, but it builds up over time, over time, over time. And that's where we are getting to now with a lot of these people. Now, we're missing the other big, huge story here, which is the pre-cons. Because, a chunk of people come in to see me and it's, well, I've got this rental property. But there is also a chunk of people coming in to see me saying, yeah, so in 2022, I agreed to pay $1 million for that condo that wasn't even built yet. And I've put down $100,000 deposit. And now I got a call from the builder that it's going to close. It's ready for occupancy. Great. And so in a lot of these projects, you get occupancy and then you get to own it. And again, you understand this better than I, but so, okay, I move in September 1st and I got to pay $5,000 a month in because I'm renting it from the builder or whatever. And then the condo corp will actually get registered on January 1st, and that's when I hand over the final $900,000 I owe. But of course, I went to the bank and asked for a mortgage for $900,000, and they say, we don't give $900,000 mortgages on $700,000 properties, which is what your property appraises out to. And so, what I'm seeing, and again, maybe I'm looking at an incorrect slice of the pie here, but it's very common for that $1 million condo to be worth 800,000, maybe 700,000. And as a result, you can't get a mortgage, you can't close. And so you say to the builder, I can't close. The builder says, you have to close, you have to give me the money. Well, I can't. So what we're seeing, we get to closing date, I can't close. So the builder sends you a letter saying, you owe bad, bad, bad. Okay, then what? We're going to sue you. And we're actually seeing builders who are starting the legal process. But what I haven't seen a whole lot of yet is builders actually taking it right to the end and being in a position to get a judgment and start, garnishing your wages or anything. Because the builders can't quantify their losses until they sell that unit. And if it was a 100-unit development and 40 units didn't close, how does the builder figure out what their losses are until they sell them? And the builder can't just sell 40 units unless he goes to, I don't know, BlackRock or somebody and they buy up all 40 units and they're going to rent them out or whatever. I don't know if that happens or not. Again, I'm making stuff up here.
It is
But
happening.
okay, well, there you go. So,
Not
and
BlackRock, but yeah.
but there are people, I'm sure, who, okay, fine, I'll give you 500,000 bucks for each of the
Yeah.
40 units. Here you go. Here's a check. 20 million bucks, bing, bang, boom. Okay, now the builder can quantify his losses. But in a lot of cases I've seen, the builder has started the legal process but has not got anywhere near to finishing it because they're going to show up in court and the judge is going to say, so how much is your loss? I don't know, haven't sold the property yet. We'll sell the property and then come back. But in Ontario, we have the Ontario Limitations Act, which I'm sure you read every day. It's a short piece of legislation, only a few pages, and it says if you're going to sue someone, you have to do it within 2 years of when they default. Okay, well, I guess the default is when I didn't close. So they've got 2 years to sue you. So I'm going to start the legal process now so the clock isn't ticking. And if it takes a year or two for me to sell the unit, I'm preserving my rights to come after you. So again, we've got this massive amount of pent up problems, pre-cons that aren't closing, that have not yet resulted in hardly any bankruptcies because the legal process hasn't consummated yet. So that'll be a story for 2026, probably into 2027.
Interesting. So a lot of these people that you're seeing, I'm going to assume most of these investors are homeowners, right? They own their existing home. And the risk, just to unpack this, is that the builder has full recourse. In Canada, you cannot just walk away like the US and say, I'm not taking this, and you're wipe your hands clean and move on. Here, the builder could go after them, as you said, they've started. But once they kind of quantify their losses, that buyer is responsible. And in theory, if the losses are 200 grand and you have 300,000 in equity in your home, my guessing is they can theoretically go after your house or kind of force you to sell to get that money. Is that kind of roughly what might
Yes.
happen to some people?
Yeah, that's what everything you said there is entirely correct. Yes, they have full recourse. You don't pay, they can sue you. But there are a lot of people that I'm talking to who are not homeowners. They bought the pre-con because they wanted to become homeowners. And they couldn't afford to buy back in 2022, but they were able to come up with the $100,000 down payment. They just couldn't come up with $1 million to buy a place. And so they thought, well, okay, we know that prices go up 20% every year forever, because that's how it always works. And so when closing comes 4 years from now or 5 years from now, my $1 million property will be worth $1,500,000. And so even if I can't get a mortgage, it doesn't matter. I'll just do an assignment sale and flip it. Somebody will give me $200,000 or $300,000 for the 100,000 I put in, and I'll be able to leverage that into a down payment. So either I'll be able to close on the deal because it'll be worth a lot more, or I'll be able to flip it and use that equity towards another purchase. So a significant portion of the people who are calling me are not currently homeowners. Some of them legitimately wanted to become homeowners and they were buying the pre-con as a way to get into the market. I'll rent for 3 or 4 more years, build up more of a down payment, everything will be fine. Others were doing it purely as a flip. And then still others did it because they thought they were real estate investors and they got four of them. And those people are toast. Like, you can't take a loss of $200,000 on four different units. So those are the people who are probably going to end up bankrupt. So you're right. If the builder finally sues them and gets a judgment against them, but they don't own anything else, fine, you can garnish you 20% of the guy's wages or something, but you're going to get next to nothing from that. So I think those are the people who will probably just end up bankrupt at some point.
Wow. Yeah, that's terrible. And I know, I mean, at least in many real estate channels, even on this one, a lot of people hear these stories. I mean, most people don't have sympathy. They think of these people as the greedy investors. But in some cases, as you're right, they were just average people who wanted to own a home, didn't know any better, got caught up in the frenzy, and overpaid for condos. And now, yeah, are gonna have to file for bankruptcy for sure. Because
Yeah, and I mean, this is a very nuanced topic because in all aspects of life, some people are stupid and some people just got screwed. So there is right now an epidemic of gambling. I don't know if you heard of the Toronto Blue Jays. It's a sporting team. They have these broadcasts every day, and every 5 minutes on the broadcast, there's an advertisement for something on your phone where you can do what's called a parlay. I don't know what that is, but it costs a lot of money. Why is that so prevalent? Is it just because, oh, well, we changed the rules? Well, no, it's because if you are 25 years old today, you know that there is no hope that you will ever be able to buy a house. Unless your parents give you the money, there is no mathematical way you can do it. You got a good job, you're making 80, 90,000 bucks a year. Well, that's 50, 60 after tax, and it's costing you 50 or 60 to live. So there's no way you're actually putting away a down payment, and you know you got to come up with 200,000 bucks, so you're never going to be able to do it. So I got to find some way to get ahead. Gambling's one answer. The stock market is another answer, which is for some people just another form of gambling. Oh no, that's investing, Doug. That's investing. Okay. If you actually understand what a call put spread is and you think you're an investor, then okay, maybe you are. Um, Crypto. Again, I'm not going to bash crypto, but, and for some people, yes, it's legitimately an investment. I completely understand Bitcoin and I think it's got a future and all the rest of it. But everything else, I don't know. And then we've got real estate. Is there any difference if you are buying 3 or 4 pre-cons on spec that are going to complete 5 years from now? Is there any difference in that between online gambling and stock market options trading and forex trading and crypto? Like, is there really? Really?
I mean, a little bit. I mean, your losses are potentially a lot higher with real estate than they are on your Sportsnet gambling app, right?
Well,
Uh,
in real estate, I can put down 5% and buy a house. Is
Mhm.
that not true? Is that not a factual statement?
Pretty much, yeah,
Um,
give or take it.
can you go to your online stockbroker and put down 5% and buy $100? No, it's like margin requirements on a stock are like 50% or something,
Hmm.
depending on the stock. If it's a penny stock, you can't get any margin. If it's a blue chip, maybe you can get more than that. But so you can be much more risky with real estate.
You
And
can 100%. I think this is like the leverage trap though, because
Mhm.
you're right. I mean, people got lured into this. If you think about this as this gambling addiction and people needing to get ahead, you're right. If you put down 5% and your condo has gone up or your property has gone up 10% in 1 year, I mean, on paper, you've tripled your money. You have like,
Yeah,
you started with whatever, 5 grand. Now you've got 15. I
yeah.
mean, obviously this ignores transaction costs and all of
Hmm.
those things, right? But the point is, um, because your growth, of course, is on your 10% appreciation is
Hmm.
on the total value, not on
Yes.
what you've invested. Now, the flip side, of course, the high leverage is that, when it goes down, you don't just lose your original investment. I mean,
You're
you
wiped
lose
out.
more than that, or you get
Yeah.
wiped out,
You're
right?
wiped out. And my point is that we all live in our own little bubbles, and we all think we're smarter than the next guy and everything, and we don't fully appreciate what the other guy is going through. So I am 61 years old. I'm very old. I'm probably the oldest guy probably you've ever met. I don't know. And I remember when I bought my first property. It was a townhouse in 1989,
Hmm.
and you weren't even born then, probably, John. And it was
With-
it was it was $205,000, and I thought I was a genius. And I sold that property just north of Toronto 7 years later for a $20,000 loss. So I fully appreciate that real estate can go up and go down. I know I'm telling you stories from 40 years ago, but it's actually possible. But if you're a boomer, and I'm not quite a boomer, but if you are, it's like, well, real estate always goes up. I don't know why you're complaining that you can't do it. And okay, well, we'll try it. Try being a 25-year-old today who did everything right. Their parents told them to go to school. So they went to the university, they got a bunch of student loans, because of course the parents didn't save up any money for them. And so they graduate with a bunch of debt. Unless you can get a really good job right away, you're going to spend the first 10 years of your working life paying off your student loan debt. And then maybe at the age of 32 or 33, you can start eking out a bit of savings towards your house. And in the old days, you and your spouse would combine your resources. Well, I can't afford to get married because I got all these other debts. And that's the reality for a chunk of the population today. And so they perceive that they have no other option but to roll the dice, whether it's through gambling or the stock market or crypto or real estate or whatever. So I have a lot of empathy for those people who are trying to do the right thing but just can't. Now, if you're just doing crazy stuff and didn't even read the contract before you sign it, I have a lot less empathy for you. So I'm not saying everybody is in the same boat, but I am saying there is a certain segment of the population who has legitimately tried their best and it ain't working.
hmm Yeah, absolutely. Now, I mean, you touched on a couple of things I think are important to think about. We talk about the psychology and the momentum in the market. And as far as I'm concerned, there's kind of two issues that we've talked about so far. I mean, one was this gambler's excitement that just got people not caring about what they're investing in, trying to get ahead without doing much due diligence. The other side effect of this rapid run up of prices was that people would overconsume, homeowners already have homes, overconsume, and then just rely on rising house prices to roll their new debt into, in some ways, like effectively never paying down their mortgage, just allowing their mortgage to increase in value. Do you think sort of this market that we have now is going to put an end to that, at least over the next, say, 5 years or so? This expectation that prices go up, we can gamble in real estate, or we can just roll over our debt and keep accumulating it. Do you think it's going to shift the mindset in Canada?
Yeah, I suspect it's already happened.
Hmm.
So, and again, you know better than I, but like how many home sales were there last month compared to a year ago last month? Like, is it a
Hmm.
lower number?
It is, yeah.
And is it a significantly lower number? Like
Hmm.
it's not nothing, right? Like
Hmm.
we're going in that direction. And so if I was, I don't know, 40 years younger than I am, would I buy a house now? Well, why would I buy a property now when I know that 6 months from now it's going to be lower? Like it doesn't make any sense. I might as well rent for 6 more months. Rental rates are actually going down in some places. So why not just keep banking that money and get something cheaper in 6 months? So again, the people that I talk to, the bloom is off the rose. And it's very common for someone to come in and see me, and I say, well, if you file a consumer proposal, your credit's going to look bad because you're going to file it. And they go, you know what? What do I care? I'm not buying a house anytime soon. Like my credit is not the thing I have to live my life for anymore. So for a lot of people, yeah, I think it's already happened. It is no longer an aspirational goal because it's so far out of reach that I'm not even going to worry about it.
So, where do you see us heading into 2026? I mean, you kind of mentioned that you think things will get worse. Where do you think we go in terms of insolvencies? Do you think it's going to be an acceleration of homeowners or more renters? And I guess what's just your outlook for the year ahead?
Well, last year, I predicted that levels would be higher this year, but they're not as high as what I predicted. So, what do I know? Clearly, I do not know. I do not see how insolvency rates can fall, but let's jump out of our bubble here. I mean, obviously, I'm the bankruptcy guy. I think everything's going to go up. That's what I think. The real estate guys always think everything's going to go up. So, like I said earlier, credit card debts are at record highs. There was a big deleveraging during the pandemic, but since then, the trend is right back to where it was. Interest rates, I mean, I don't know what's going to happen to them next year, but I believe they are higher than they were a couple of years ago. So if you're refinancing, you're paying more in a lot of cases. Not all cases, but in a lot of cases. So that can't be good. We've got immigration, which again, I'm not an expert in this, but it sure seems like it's going way down and maybe even going negative. So what does that mean? I don't know. Does that mean that people can buy more properties because there's more availability? Or does it mean you lose a bunch of people and the economy goes down and as a result, we're all unemployed? I don't know. Like there's so many different factors. What's that guy? I forget his name. He's the president of the United States. What's he going to do 15 minutes from now? I don't know. Like as we are recording this, I believe there are tariffs, but probably by tonight there won't be, and by tomorrow morning they'll be doubled. So I don't know. How's that going to affect everything? I have no idea. So if I had to guess though, and since you asked me, I would say, well, yeah, I think all categories of personal insolvency will be higher next year. I think for renters, it will be higher because they're the ones who are more likely to be suffering job loss, for example, because they're probably not the president of the company. They're probably a more vulnerable worker. And they also don't have a whole bunch of built up equity to survive the storm. But I also think we will see more homeowners, which I mean, that percentage, as I said, has been increasing throughout the year because they will be getting capped out and they'll realize, look, I just can't do it anymore. The other interesting trend is that the percentage of bankruptcies as compared to consumer proposals is increasing.
Mm.
So
Maybe unpack
as
that for everyone. Yeah, why
yeah,
that's.
so there are two forms of personal insolvency in Canada. Bankruptcy, everyone kind of understand is like, yeah, I lose all my stuff. Yeah, pretty much. If you own a house that's worth $1 million and it has $1 million mortgage, it's not worth anything. You can go bankrupt and keep it. So long as you're paying the mortgage, everybody's happy. But if you have money in your TFSA or in a stock market fund or something like that, that's an asset. You lose it when you go bankrupt. If you own a fancy car with no loan, if you own a house with a bunch of equity, you lose it. That's the concept of bankruptcy. You lose your assets, you get rid of your debts. In the other form of insolvency is a proposal, which is exactly what it sounds like. We go to your creditors and we say, look, I don't want to go bankrupt because I did the math. If I went bankrupt, it's going to cost me 15,000 bucks because of my income. The more you make, the more you got to pay while you're bankrupt because I got some money in my TFSA, whatever. So here's my proposal, Mr. Creditor. I will give you $30,000. I got 100,000 bucks worth of debt. I can't pay it back. If I go bankrupt, it's going to cost me 15,000 bucks over the next 21 months. I'm willing to give you guys 500 bucks a month for the next 5 years. That's $30,000, twice as much as you get in a bankruptcy. It's going to take 5 years, but you're going to get more money. And in most cases, the creditors go, well, we'd like our 100,000 bucks, but okay, we'll take the deal. We'll take the 30,000. So if you think your income is going to increase in the future, a consumer proposal is a good idea because you can lock in the payment. If you think that house you own that has minimal equity now is going to increase in value, again, consumer proposal, good way to keep your house. Well, the historically, if you go back, 2, 3 years, 15% of insolvency filings were bankruptcies, 85% were proposals. Now, if you go back 30 years, 40 years, it was the other way around. It was basically everything was bankrupt. Proposals didn't come into being until 1992. Well, what we are seeing now is that percentage of bankruptcies is increasing because an increasing number of people just can't do it. It's like, I don't even have the money to make a deal. So if I had to predict, maybe in 2026, we're going to see 20% of filings being bankruptcies, 80% proposals. And it could continue to increase. If we have a massive real estate wipeout, which I'm not predicting because I have no clue, but if we did, then probably that bankruptcy percentage goes up even more because people have so much debt that they just can't make a proposal. And just to confuse your listener even more, to file a consumer proposal, your total debt must be $250,000 or less, not including the mortgage on your principal residence. So when you come in to see me and say, "Yeah, I bought this pre-con for 100,000 bucks and now it's only worth 700,000, I'm going to lose 300,000 bucks on the deal." I'm like, "You can't file a consumer proposal. Your debts are too high." That's never been a problem in the past. But now we are running into people who have so much debt they can't even file a consumer proposal. Now they can file a different kind of proposal. It's called a Division One. That's what corporations use, but it's more expensive and probably doesn't work. So I
Hmm.
think the math is going to necessitate more bankruptcies in the future.
Hmm. So do you think this kind of increase in bankruptcy is partly just driven by, again, like perhaps some of these people with this real estate assets and more debt that cannot be obviously included in a proposal?
Yeah, more debt and less income,
Hmm.
comparatively speaking.
Hmm.
So again, I don't know what the inflation rate has been over the last 5 years, but I assume it's like 20 or 25% or something if you add it up over a 5 year period. So has your income gone up 25%? If it has, I guess you're staying even. But if it's only gone up 20%, okay, now you've got a bit of less cash flow each month, which is less money to support paying a proposal. We're in this really weird time in history because it used to be you'd come into my office, we'd file a proposal, and we'd offer 300 bucks a month. And it was a little tight, but you knew that, look, next year my pay would go up a bit. So by next year, 300 bucks wouldn't be a problem. And by the end of the proposal, year 4 or 5, 300 bucks is going to be easy because inflation's going to carry me along. But now it's the opposite. It's like, holy crap, next year, my expenses might be even higher as a percentage than my income. I'm barely scraping by making that $300 payment today. Maybe by next year, I can't afford it. And I've never seen that in the 30 years I've been doing this. So it's a combination to answer your question. Yeah, it's a combination of people being squeezed on the cash flow side and being squeezed on the asset side.
So, I mean, maybe if we can turn things around and put an optimist's hat on, what would need to happen for insolvency filings to actually materially decline? Do you think it is about lower rates? Is it about higher wages? Is it about home prices kind of starting to increase in value again rather than decrease? What do you think it would take to see a shift in insolvencies?
Um, well, so if home prices go up, then you're right. The home owners are in a better position, but because they got more equity, but the renters are probably in worse position because their rent probably goes up. So I don't know how much that helps. Now, your first point was interest rates, of which again, I'm not an expert. I've got all the charts on my screen. I don't understand any of them. So a typical 5-year mortgage rate right now is what? Like, are we talking 5%, 6%? Is
We're in
that
the
the range?
fours. We're in the
Fours.
fours.
Okay, so that shows you how much I know about this.
Mhm,
Okay, so let's say I can go out and I can get a mortgage today at 4%.
mhm.
If interest rates drop to 3.75%, does that make a difference?
No.
No. How much do they have to drop to make a difference? I don't know. I mean, everybody's situation is different. Are we talking about a 1 year, a 5 year, a variable? What are we talking? But going from 4% to 3.5%, does that move the needle? Is that going to make me rush to buy a house? Well, if I have a 5 year locked in mortgage, it makes absolutely no difference. It's only when I come up for renewal. If I got a variable rate, okay, maybe it makes a difference. But I cannot envision a scenario where interest rates can come down fast enough, quick enough to make a significant difference. And again, I'm not the expert, so everyone can put their notes in the comments about how I don't know what I'm talking about. But so I don't see that saving us. And if interest rates are coming down, why are they coming down? Well, because we're in a recession, which means we got, less income, less job growth, all the rest of it. Okay, but your question was for me to be optimistic. Um,
Like, what would need to change in
I
our
guess
economy?
if the economy improved, if there were more
Hmm.
jobs,
Hmm.
and if there were more better jobs.
Hmm.
So the lower end is being hollowed out at the moment.
Hmm.
So I'm told, and this again, I'm making this stuff up, but if you go into that restaurant place, there's like an iPad at the front and you punch in your order and then it somehow gets to you. It used to be you talk to a human being. Those entry level jobs just aren't there anymore. So how do I get that job to then grow? Now, I guess again, you're asking me to be optimistic here. So perhaps if if immigration is going down or not increasing as much, some of those jobs that were being done by immigrants perhaps now get done by Canadians. They get done by, students, new entrants into the workforce. Maybe that does stimulate stuff. Is that going to happen? I don't know. I have no idea what the impact of tariffs is. But I believe you made the comment about perception or whatever your word was. Okay, I guess the answer to your question is if we believe things will get better, then they will. So if we believe that, okay, this tariff thing is going to blow over and inflation's going to be reduced, okay, then I guess I will go out and get a second job and try to make some extra money because I know things will be better in the future. As opposed to today, where it's like, why would I work overtime? There's no point. I might as well just stay home and play video games. So if our perceptions change, then I guess that's what will carry us out of this. And can it happen quickly? I don't know. Sure, it can happen quickly. Anything can happen quickly. I mean, if you and I were having this discussion in April about the Toronto Blue Jays, you would have said, yeah, this season is lost. They're not going to make the playoffs. It's a disaster. They're playing horribly. And they almost won the World Series. So things can change, not for the Toronto Maple Leafs. That there's nothing that can be done there, but Raptors maybe. So yeah, I guess if there are some things that change, maybe the prime minister guy makes some deals with people, and we just think things are going to get better. Maybe that will happen, but I have a hard time coming up with the exact scenario.
Hmm. All right, that's helpful. Now, as we wrap up on our segment today, I'm going to ask you one final question. If someone who's watching is struggling with debts today, what are some of the first steps that you think they should take? And are those first steps different if they are a renter versus a homeowner?
Yeah, I think the first thing you have to understand is that compound interest works both ways. So if you got a bunch of money in the bank, it's building, and if you got debt, it's going the other way. So the first thing you have to do, whether you're a homeowner, renter, whatever, is take inventory. So what do I own? What do I owe? And on the asset side of the balance sheet, be realistic. Like talk to a legit real estate person to tell you what your place would actually sell for, not some pumped up number, and write down every debt you've got. Mortgage, HELOC, credit cards, taxes, whatever. What's the amount? What's the interest rate? What's the minimum payment? All that kind of stuff. And then be realistic about what you can do to improve your situation. And if the answer is, yeah, I got 5,000 bucks owing on my credit card, you know what I could do? I could pick up a part-time job for a few months, work some Saturdays, and earn a bunch of money and make a big dent in that debt. Great, then do that. Maybe the answer is, I don't need two cars, I only need one. Maybe I do sell my place because it's probably not going to double in value in the next 15 minutes. So maybe I'm better off selling now, renting, freeing up some cash. And as a result, I'm able to use that to deal with my debts. So I think you got to be very honest about your own personal situation and figure out what you can do about it. More than half of the people, probably three-quarters of the people who call my office, we end up not doing a proposal or a bankruptcy for them. They end up increasing their income, reducing their expenses. Maybe they move back home, maybe they sell their place, whatever, and they're able to work through it on their own. If that's the case, fantastic. That's great. If your debt is overwhelming, or even if you think it's overwhelming, then you should talk to a licensed insolvency trustee because we're the only professionals licensed by the federal government to do proposals and bankruptcies. There's only about 1,000 of us in Canada, and probably only 400 or 500 of us actually do this working with individuals. But that's where you want to start and ask questions. Okay, so can I work it through it my own? Could I do a proposal? Could I do a bankruptcy? What could I do? I think the sooner you have that conversation, the better, because debt problems do not get better on their own magically. It's just not how it works. So I think you got to, you do that self-assessment and figure out what's going to happen. And obviously you got to factor in your own views of the future too. If you legitimately think that the real estate market will be significantly better 6 months or a year from now, because interest rates will be lower and whatever, then okay, can you hang on for 6 months or a year then? And if you can, great. But you should actually think about the decision. Get a piece of paper, write it down, use a spreadsheet, whatever it takes, so that you're making a decision having looked at all of the facts and all of the options.
Awesome. Doug, thank you so much for that advice. And thanks for taking the time to join us today and talk about the things that you're seeing in your industry. We really appreciate taking the time.
Great to be with you anytime, John.